The Bank of Canada just lowered its overnight rate by 50 basis points or 0.5%. Stay tuned to see how it could affect you as a home buyer, a homeowner, perhaps a business owner, and an investor, or perhaps even a retiree. I'll talk about the typical and expected impacts first, and then add my own commentary to each. So let's talk about the first-time home buyers or the people that are in the market right now. If you're a home buyer, the idea is that as rates continue to drop, affordability gets better for you, but that also invites more buyers. More buyers will be invited back into the market, which theoretically, if prices were going down, it will stabilize it. It could potentially even increase the average price of homes if the number of buyers that come back outstrips the units that are available for sale. Now, in a normal economy, home purchases should follow employment and income growth. So even if rates are lower, if you don't have a job, you're out of the market. However, there are a lot of pundits that are saying there's still a lot of pent-up buyers and demand because there's people that have been waiting on the sidelines for the rates to cool off. Just imagine how high things have been. Imagine if you were qualifying for a mortgage at fixed rates in the 6.5 or 6.75% range. That means your lender will test your capacity to borrow at 8.7% or higher. So that's where this idea is coming from. So watch out, this could be true. I actually don't believe that the effects of this change will be felt in mortgages right away, not immediately. See, the overnight rates determine a lot of the short-term rates and instruments. Think savings and GICs. Mortgages, on the other hand, especially the fixed kind, are typically pegged against long-term bond rates, which the BOC rate does impact, but that's many dominoes that need to tip before that happens. So in my opinion, this rate change will not impact pricing, at least not in the short term, as most people still opt to qualify for longer fixed-term mortgages. The Canadian favorite is still the 5-year fixed. So the other note here is the signal that we're getting from the Bank of Canada. They're pretty much telling us that they're willing and planning on cutting rates further. What that tells me is that human behavior will prevail. Human behavior will latch onto that idea, and they'll end up waiting further until more rate cuts happen. So that pent-up demand might not come into play yet. See, those 2 points, the fact that the fixed-term mortgages don't move in lockstep with overnight rates and that the humans will keep waiting, could mean that there's really no material change in home prices until spring or mid next year. So what if you already own a home? Now, the activities of the housing market from a buyer's perspective, that movement can increase the value of your home. So if you had plans to refinance, you can take advantage of that price increase or stability if you're already preparing to do that anyway. But again, I don't think that price change will happen tomorrow. This is where I actually want you to pay a little bit more attention. If you took a mortgage in 2019, 2020, or 2021, depending on how long your term was, you could be due for a renewal right now or in the near future. I can't give you advice on what to do with your mortgage. This is what I'll tell you though. You need to seek a competent mortgage broker and see if you can trust them. Find someone who can walk you through the dollars and cents, not percentage points. This really irates me when banks and lenders try to give you guidance on your mortgage just by looking at percentages. You don't spend in percentages, you spend in dollars. See, the most infuriating thing to me is when you don't get that information. They just dangle rates in front of you, and they will actually give you incentive as far as comparisons are concerned. They'll give you an incentive to renew early or lock in for a longer term based on the current rates right now, when mortgage rates are potentially coming down lower. So why would I lock in? If you can wait until the fixed rate mortgages are down further, I would. If you're already scheduled for a renewal now and you're not sure what to do, you may be faced with a month-to-month rate that is significantly higher. So that's how you will be coerced into locking into a term right away. But this is why you need to talk to someone who can actually do the math for you based on your situation. It may be worth looking at a higher rate for a month, 2, or even 3 months if it means you get to lock in a lower rate later if your belief is that the rates are going down. For sure, during that short period, your payments may be incrementally higher and you're going to be paying more interest. But if you can get a rate that is 0.5 or 0.75% lower later in a few months, I would really do the math on that. This is the quintessential variable versus fixed, or when do I do the fixed, right? It's all dependent on your belief. So do you believe that rates will continue to go down? If you believe so, let me know in the comments, because that math then could make sense for you to wait before locking into a new term. So let's move on to the business owners. I suppose that's too broad of a group to just lump in together. So let's talk about this in 2 segments. Those that are in growth mode first, and those who are considering selling or their succession. So to those who are still in the day-to-day, you may have outstanding commercial loans for your equipment, your building, or other intangible purchases that you've committed to in the past. Start paying attention now, whether it's worth refinancing those and getting better rates and better terms. Maybe you're planning on buying equipment. If it's not an absolute rush, pay attention to your lending terms and see if you can make things work just a little bit longer so that you can get a better price later perhaps, and then better financing options. It may also be ideal for you to consolidate or refinance liabilities that you have. Now, aside from being aware that rates are changing, your action item, as somebody that's thinking about growth and investing in your business, your action item is really to get your books ready. Make sure you are ready to show clean financials. If you have a CFO or a controller in your business, most of those past comments that I just made may be moot to you. But I know a lot of small business owners that don't have anyone to talk to them about this, even just basic financing conversations. The only people that talk to them are the people that are selling the equipment to them, which does not really represent their best interest. Now, to the sellers or those who are considering their succession plan, if you have a business, even if your accountant or the people around you, if they tell you that it's not worth anything or that no one will ever buy it, still get a business appraisal. Why? Well, wouldn't you want to know what your business is worth to other people? Number 2, private equity firms and roll-up corporations tend to slow down when money is expensive, when rates are high. Things slow down, they stop their buying. I know this to be true in the dental business and other medical professional businesses where there has been significant consolidation. However, when these guys, the buyers, see commercial rates get to 10, 11, 12%, it's hard to finance a purchase. It's hard to make the economics work. See, now we're entering the other side. As money gets cheaper, with these rate cuts, these entities will be more active, again, because they will have capacity. See, even if it's not a PE firm, even if it's a junior employee or it's an internal succession that wants to buy into your business or take over your business altogether, they will likely need to finance that. So if you believe rates will continue to go down and you were already thinking about a succession plan anyway, I just dropped a reminder to you to clean your books, clean your processes so that somebody will actually want to run that business, somebody will actually want to take over that business, dress the business, essentially. Now, to the investors, to the retirees, what do these rate cuts mean to you? Well, first and foremost, say sayonara to the GICs and HISAs that pay 5%. The high interest savings accounts that were giving you those kind of yields, those are going away. Perhaps they're actually already gone. Unlike fixed rate mortgages, these short-term cash instruments and short-term fixed income investments will follow this reduction from the BOC in short order. GICs are already bad investments, in my opinion, for long-term growth and long-term income planning to begin with. Just consider this, that during the periods where you were getting these 5, 6% HISAs or GICs, inflation was at 8%. So even at those high interest rates that made a lot of investors really excited, they actually lost money in real returns net of inflation. So now inflation was just announced at under 2. I believe it's 1.6. So soon these GICs will likely come back down to 1 or 2%. So to the long-term investor, you should have very little GICs to begin with, unless there's a specific purchase or expense that you are saving money for in the near term. As a retiree, I know that many of you watching, because of the uncertainty that we face in the last few years and the attractiveness of the risk-free 5 or 6%, a lot of you have gotten out of the market in 2022 and 2023, and even this year perhaps, and you put a large position in GICs. Now, I've seen this in some households, $500,000, $1 million, $1.5 million in GIC balances per household because they didn't know what to do and they're unsure about how to invest as they enter retirement. So they cashed out. The good news is we run most of our plans and assume low conservative returns, typically averaging 5% or below. So during that period, they would have met the target rates of return. You would have met the target rates of returns for a conservative plan. So that worked out for you. I suppose if the action was for short-term security, that makes sense. The issue here is inertia. You may end up rolling and laddering your GICs even as rates start going down from 5 to 4 to 3 to 2. This will severely impact your long-term retirement prospects. So as a retiree, you need to consider alternative strategies to give you peace of mind, the same peace of mind that you're probably finding in GICs. If those no longer work, you need to find that elsewhere. I'll talk about those strategies in upcoming videos. Bye!